I'm going to be talking to Ed Hurst, energy economist at the University of Houston and a frequent commentator on our interviews. And we're going to be talking about Chevron's purchase for $53 billion of Hess and why they did it and what it means for the larger oil market. So welcome to the interview, Ed.
Thank you, Markham.
Okay, so we've got this, basically Chevron cleared some regulatory hurdles now, can purchase Hess for 53 billion. It gets a lot of oil in Guyana. Um, this seems to be part of a larger trend within the industry of consolidation amongst the big players. Is that correct?
Yes, it is. And keep in mind, of course, it's not an all cash deal. It's a merger. It's an exchange of Chevron stock for Hess stock. So in terms of cash outlay, it's not as big as it seems.
Gotcha. Now, one of the issues that part of the discussion in Canada around the future of oil is what happens after 2030. The OPEC says no growth out to 2050. The IEA says peak oil demand in 2029, then decline in the early 2030s. And I've seen some news stories, from Reuters, so these are reputable, saying the big players are consolidating because they want to get oil that has a break even around $30, $35 per barrel to manage a declining market. What's your take on that?
Well, in any kind of down market, we're going to see more consolidations. And I'm not talking about the application of AI to the oil patch, although that's developing. It's just you don't need dozens of CEOs, dozens of CFOs, dozens of geologists. And there is a recognition, of course, especially in the United States, that ExxonMobil doesn't control the price of gasoline across the land. And so these antitrust concerns that were, first and foremost 100 years ago don't apply anymore. OPEC Plus is the marginal or the swing producer, if you will. The U.S. is the marginal producer because we're the high cost producer in the global oil market. So the price turns out to be whatever OPEC Plus wants it to be. Now, we do know that OPEC Plus ministers complained a week ago at their meetings that their decline rates average a little more than 5%, and that collectively they're not reinvesting at a rate to maintain level production or to grow production. So OPEC is not putting the money forward, and we know in the United States, for new drilling activity to really bump up, we need to see a price of $70 a barrel and higher for an extended period. So look at the forward curve. And so we're in a period right now of a lower oil price. President Trump likes it that way. Everybody seems to be pointing in that direction. But the lower price is hammering margins. And then, of course, in the United States, we've got a higher cost because of the steel tariffs that have been placed. That's increased the cost of wells between 5 and 12%, according to the Dallas Federal Reserve Bank Energy Survey that was released on July 2nd.
Okay, so my takeaway as a non-energy economist from what you've said is that there's some turbulence in the market now. Prices have dropped, so there's some rationalization, and the producers are deciding, do they want to invest in new production? They don't. But the big players are looking ahead to 10, 20, 30 years down the road, and they're saying we need to crowd into these lower cost fields because amidst this uncertainty, we don't know, and our best strategy is to keep our costs low and keep ourselves competitive. So would you agree that and I'm getting this argument from Reuters, is that the majors are positioning themselves for a period of decline?
Oh, absolutely. They've been doing this for a long time. Since the 90s, ExxonMobil has been spending more on dividends and share buybacks than it has on expanding its business. You would call that a liquidation. Keep in mind that for the last dozen plus years, the oil patch collectively has been the worst performing sector in the S&P. Wall Street's not advancing at a lot of money, especially domestically in the U.S. Chevron had an opportunity to buy Hess primarily to get its hands on the Guyana portion that Hess owned, and they were able to buy it at much less than the cost of building it. In financial circles, we refer to this as Tobin's little Q. It's the ratio of the market value of the asset, the stock value plus the debt value, over the intrinsic value or the replacement value. And so, in essence, what we're seeing is that oil and gas in the ground is selling at a discount in the stock market to what its value would be if you were to go in and have to explore and drill for it. So this is a great opportunity, and it will be for the next, well, maybe the entirety of the Trump administration, for companies to grow by way of acquisition, merger, and they can do it just by simply exchanging shares. Chevron announced yesterday 575 layoffs of Hess employees by the end of September. This is pretty quick assimilation, but they don't need uh, duplicate employees doing duplicate jobs.
And so getting back to Tobin's Q, and Tobin was an economist, and I gather that you were one of his students actually back in the day.
Tobin was awarded the Nobel in 1983, uh, primarily for his work on liquidity choice portfolio management.
Okay, that's all we need to know about the economics of this. But just for our audience who are like me are not economists, most of them, if the Q is over one, that means that it's a good deal for the company, and the value is higher than the oil in the ground. And if it's under one, then that's not a good deal, and it costs more to replace than the value of the oil. Have I got that right?
That's exactly right. And so, what you long for is for a ratio of the market value to be much greater than the intrinsic value, the book value, the cost of replicating it. Coca-Cola has a value in the market that's far greater than the cost of having put together its formula, for example. Microsoft, the cost of Windows is virtually nil, but the market value is fabulous, isn't it?
Okay, you made a point to me off camera that I want to talk about, and that is that much of the oil patch has a Q under one. And what are the implications?
Well, first of all, it means that Wall Street's not going to be investing or providing capital for companies to go out and drill for new prospects. The companies are going to have to deploy their own capital to drill, and for the last dozen years, Wall Street has not been sending money to the oil patch. We know that. They can put money in any other industry and get a better return. Um, Company managements, though, are sitting there looking at their stock and bonds together, trading at a discount to the replacement value of their assets. You know, Nowhere is there a better example of that than BP, and well, perhaps Shell. Um, and gosh, I even saw some notions in the press today that well, maybe Chevron is now a target for Exxon, but logically, you might think that Chevron would be a target for Saudi Aramco or CNOOC.